Rick, between 2000 and 2011, gold was up over 600%. Do you think we're going to see a similar move like that now?
I think we'll only do half that well.
That's not nearly good enough. I need to know, what's your target price on gold?
I've told you before, I don't own gold because I think it's going to go to 3,000. I own gold because I'm afraid it's going to go to 9 or 10,000. We'll talk about the arithmetic around that in this interview.
Rick, we are living through some very precarious times right now, and during times of uncertainty, one of the ways you can hedge your portfolio to protect yourself on the downside is through gold. And gold is one of the best performing metals here in the past year. It's trading at or near all-time highs. So I want to start right here and get your views on gold. It's already had a big move. Do you still think there's a lot of room to go on the upside?
I do. Several months ago when you interviewed me, I think I said I didn't own gold myself because I thought it might go to 3,000. I said I owned it because I was afraid that it was going to go to 9,000. That's not a price projection. But the truth is that gold has, for a very long period of time, taken care of portfolios well when people were concerned about the maintenance of their purchasing power, particularly in reserve currencies like the US dollar. Anybody who isn't concerned about that right now, I think, is operating on questionable premises. So I absolutely positively, it's very difficult for me to understand why somebody wouldn't own gold, in fact.
And so I want to pin you down now and try to get a target price out of you. And if I compare this time to the early 2000s, in the year 2000, gold bottomed at $250 an ounce. I can't believe I wasn't backing up the truck then, but I wasn't. I was still buying tech stocks. And between the year 2000 and 2011, it went up to $1,900 or 650%. Do you think right now we'll see the same sort of corresponding move? And if you to use the same sort of numbers, that would equate into $6,000 an ounce.
Not from the base it's at now, 2,500. If it went up sixfold, that would mean it would go to $13,000 or $14,000, a different move.
Yeah, and I should have provided more context. I was really looking at the low from the year 2015. It was around $1,000.
Okay. I mean, sixfold, no. But threefold wouldn't surprise me at all. Here's why. My belief is over the next 10 years that the United States dollar will probably lose about 75% of its purchasing power. I say that because the on-balance sheet liabilities of the US government are in excess of $30 trillion net. But more importantly, the off-balance sheet liabilities of the US government, Social Security, Medicare, Medicaid, federal pensions, military pensions, exceed, according to the Congressional Budget Office, $100 trillion. So the US federal government is $130 trillion behind the eight ball. That's before state and local governments. To put that into context, gross revenues for the US government are $5 trillion a year. So the debt is what, 26 times gross revenues before any expenditures? We had a circumstance like this before, although not as dramatic, in the decade of the 70s, and the US dollar lost 75% of its purchasing power. My suspicion is that the way that we deal with all of these entitlement liabilities is that we honor the nominal obligations while we inflate away the net present value. If you take down the purchasing power of the US dollar by 75% without a real move in the gold price, you triple the gold price in dollar terms. And that's precisely what I think is going to happen. And by the way, I take no particular pleasure in this. The set of circumstances that causes very strong gold rallies are usually very harmful to the rest of one's life and one's portfolio. And my life is quite good. I would prefer that I didn't have to have this kind of concern. But it's very difficult looking at the arithmetic around on and off balance sheet liabilities in the US and not be concerned about the maintenance of purchase power of the dollar.
And so once again, I want to get a price out of you. How high do you think the price of gold can go? I thought the numbers I was using, it could go to $6,000 an ounce. Is that feasible in the next few years?
Oh, I think it could go a digit. I think you could see, as long as you're giving me a reasonable period of time, 5 years or so, I think it could easily go to 9 or 10 or 12. I'm not saying it will, but I'm certainly buying it in anticipation of the deterioration of the purchasing power of the US dollar by really substantial magnitude, 75% decline, like we had in the decade of the 1970s. By the way, that number doesn't come from some cranky old libertarian. That number comes from the Office of Management and Budget. It's a government number, not my number. It's important to remember history, and it's important to remember why history occurred. If you put the arithmetic of U.S. government debt and deficits in the context of history, you have reason to be very, very, very nervous. And in that context, understand that $10,000 gold isn't today's $10,000. It's the $10,000 then. But if you had your choice after 5 years of having $10,000 gold or having had $10,000 drawing 4% interest, clearly you would prefer the former to the latter.
So let's look at some of the factors that might drive the price of gold higher. And in the last few years, the big one has been central bank buying. And the real catalyst came in 2022 with the invasion of Ukraine. Shortly thereafter, the US and a number of other Western nations seized Russian Federal Reserve assets to the tune of $300 billion. And so a lot of central banks and a lot of governments around the world said, we don't want that happening to us. Let's start buying gold and we're going to take it home so no one can seize it. And since that time, many countries, I want to say China, India, and many other central banks have been acquiring gold, acquiring approximately 25% of global production. And now China holds 2,200 tons of gold versus the US, which holds 8,100 tons of gold. And that's not really a big number. Do you think the China and these other central banks are going to continue buying it and be as aggressive as they have been in the last few years?
I do. I think they have no choice. If you're a central banker, by the way, buying gold is a very hard thing to do emotionally, because gold calls into question the very premise of central banking. Traditionally, central bankers have preferred to own Treasury securities issued by other central banks because it legitimizes central banking. But things changed, as you suggest. The United States decided to weaponize the dollar through the extraterritorial imposition of U.S. will in the SWIFT banking system, and then, of course, by irrespective of your belief in U.S. foreign policy, by stealing $300 billion worth of Russian gold. I think that in particular China, given the size of the economy and the importance of exports to the Chinese economy, has no choice but to go to gold. They look at the US government as one that they are in a period of increased conflict with, and they look at the predisposition of the US government to weaponize the world's reserve currency. And they also look at the US 10-year Treasury paying 4% in a currency where, from their point of view, the purchasing power is declining by 7.5%. And they say, now, wait a minute, we're giving seniorage to the US government who doesn't like us, and we're losing 350 basis points of real yield a year. This is a bad deal politically, and it's a lousy deal arithmetically. Against that, you look at any other currency they can trade in. Just how many rubles would the Chinese like, right? The answer is not very many. They're going to go to the BRICS currencies. I mean, none of the underlying currencies behind the BRICS are convertible. Why would the Chinese do that? The truth is now, when China gets rubles, what they do functionally is they turn them into dollars. They have no choice but to hold gold because there isn't another asset class that is simultaneously an asset and a medium of exchange other than gold and the US dollar. And the US dollar has proven itself to be a less reliable store of value and an increasingly politically challenged medium of exchange.
And in addition to central bank buying, there's many other economic factors that can drive the price of gold higher. And if you look at fiscal policy, for example, excessive spending that we saw in the last administration, or the imposition of tariffs that we're going to see in this administration. There was an interview conducted by Warren Buffett recently, and he said that tariffs are a tax on the consumer. And he also said that tariffs are inflationary. He even went on to say that tariffs are really an act of war. And I think what he meant by that was they're an economic act of war. But what are your views on tariffs, and do you agree or disagree with Warren Buffett's assessment?
I agree completely. Tariffs are taxes. The idea that you put a 25% tariff, as an example, on Canadian goods coming to the U.S., and that doesn't flow through to the U.S. consumer. I mean, our president shouldn't be smoking whatever he smoked when he decided that tariffs somehow weren't taxes. That's just an insanity and an absurdity. But the rest of what Buffett said, one should be paying attention to, too. Too many people, when they look at the U.S. dollar, are glossing over some basic arithmetic. A lot of people, when they look at the stability of the U.S. dollar, not Buffett, by the way, a lot of people, when they look at the stability of the U.S. dollar, they assume that the inflation rate that impacts them is the CPI. The CPI would tell you that the deterioration of the purchasing power of the U.S. government, of U.S. dollars, 2.6% a year. I challenge you to find any American whose basket of goods and services is only going up by 2.6 a year. Take the period 2020 to 2025. Tell me what happened to grocery bills. Tell me what happened to health care and health insurance. Tell me what happened to rent. Tell me what happened to gasoline. And tell me that the U.S. inflation rate is 2.6% a year. Besides which, the CPI doesn't include tax. The most important component of a household budget in the United States is tax. And the so-called rate of inflation doesn't include tax. I ran an exercise on my own budget, not a slavish one, a back of the envelope exercise, and the basket of goods and services that I consume, and I'm an old rich guy, I don't buy much, shows me that the purchasing power of my savings is deteriorating about 7.5% a year. Now think about the impact of that on the U.S. Treasury. I own a U.S. Treasury. If I did, a 10-year Treasury, I'm getting paid 4.5 in a currency where the purchasing power is declining by 7.5. That means if I loan my money to the U.S. government for 10 years, they solemnly swear after 10 years to give me back 60% of what I gave them. That's a good deal, right? If you believe that gold trades inversely to the confidence associated with savings instruments denominated in the world's reserve currency, obviously one answer is gold. Certainly the answer I've chosen.
The power to tax is the power to destroy.
Correct.
And I agree with what you said on inflation. I live in the city of Toronto. The municipal government just put the property taxes up by 6.9%. In the last 5 years, they're up over 25%, if you can believe that. Anyhow, one other question that came up during the Warren Buffett interview, they asked him about the economy, and he actually declined to answer. But I don't think you have to actually hear an answer out of Warren Buffett. When you look at his actions in the last few years, he was a massive seller of Apple. He used to own $178 billion worth. Now it's down to $70 billion. He sold huge positions in Citibank and also Bank of America and many other stocks. But what are your thoughts on the U.S. economy right now? And would you agree with Warren Buffett's assessment of the U.S. economy?
Over the last 60 years, betting against Buffett has been a really stupid bet. Putting it in perspective, over half of his assets now are cash. Mr. Buffett understands completely that holding cash at 4% generates a negative real yield. So there is a cost to him of having too much cash. He declined to answer publicly anything about the economy. But if you look at the portfolio distribution that Buffett's exhibited over 3 years, he's gone from 20% cash to 52 or 53% cash. I have a serious time believing that Mr. Buffett's analytical faculties are diminished enough that he can't find good companies. He's traditionally been very good at that. I think he's absolutely positively making a market call.
And when you look at the U.S. economy yourself, I mean, the government tells us the U.S. economy is fine. It's growing at 2.5 to 3% annualized. What are your thoughts on that?
If you're Rick Rule, if you don't have Buffett's problem, which is allocating $600 billion, if you're Rick Rule, the U.S. economy is in okay shape. Artificially low interest rates benefit guys like me. I have access to credit, which is subsidized, and I have the knowledge to learn how to use it. But there's a very, very, very thin veneer of people for whom the U.S. economy is working. People who don't have my skill sets, people who don't have access to credit, people who don't have a knowledge of how to use the credit. For those people, things are challenged. There's a wonderful joke in the little town that I live in. Yeah, the economy's generating a lot of jobs. I got to have 3 of them to live. There's some subcurrents under the U.S. economy which are problematic. The economy is working for some, it's not working for most. But the scary thing is, I think, the entitlement liabilities. Most Americans believe that the U.S. debt is $36 trillion or $30 trillion net. They forget the net present value of unfunded liabilities, which exceeds $100 trillion. There's a whole bunch of Americans who believe that Social Security and Medicare and Medicaid and all that is going to be for them. If it is going to be there for them, somehow we need to find $100 trillion, which is to say we need to find 3 times our GDP.
You are a big believer in gold, and you have said you want to use gold to hedge yourself against any sort of economic decline. And we know Warren Buffett and Charlie Munger were never big proponents of gold as an investment. And Charlie Munger had some amazing quotes. And one of his quotes that I always enjoyed had to do with gold. And he said, even if you make money trading gold, you're still an idiot. And he was just, I guess, alluding to the fact that gold does not provide any cash flow. It doesn't pay a dividend. It provides no utility. What are your thoughts on that? What would you say to him?
If I were Warren Buffett, at least a younger Warren Buffett, I would agree with him. If I had the ability that he has to find great businesses with pricing power that could shield me from inflation because they produce such great products that they could increase their margin at the same way that the deterioration of the US dollar was happening, I wouldn't need to own gold. But I'm not as smart as Warren Buffett. I'll tell you that right now. Absent the ability to generate performance that outstrips the S&P by 400 or 500 basis points a year for 30 years or 40 years, which sadly Rick Rule can't do. For mortals, they have to own gold. But Buffett's not a mortal. Buffett recognized, Coca-Cola at $2 a share. He recognized Columbia Pictures. We'll see, assuming that Buffett has 5 or 6 years left in him, what his feeling is if his cash hoard grows to 70% or 75% of total funded capital at Berkshire Hathaway. It may be that the circumstance compels even Mr. Buffett to own the pet rock.
So let's talk about interest rates now and the yield curve. And the Fed has been very aggressive in cutting interest rates. And in the last quarter of 2024, I guess in the last 4 months, they cut interest rates 3 times or 100 basis points. They recently said during a Fed meeting that they anticipate in cutting rates twice in 2025. But so they got the short end of the curve under control, but the long end of the curve has been very volatile. It's gone from a low of 380 up to 470, somewhere in between there right now. But there's a lot of commentary that they've lost control of the long end of the curve. What are your thoughts on that?
Well, this is hugely interesting to me. Really since 1992, since the demise of the bond vigilantes, the Fed and the political forces have been able to manipulate interest rates lower. The fact that they are jawboning interest rates down and in fact moving the cost of funds down, the Fed funds rate down, while at the same time losing the long end of the curve. And what I think is the related fact that since 2022, both the interest rate, the long interest rate, and the gold price have gone up simultaneously, tells you that there is a change in the risk assessment around the long bond. The arithmetic is horrible. If I'm right, if the deterioration of the purchasing power of the US dollar really is 7.5%, and long bond investors are experiencing a 300 basis point negative real yield, then you're going to begin to see a decoupling of the interest rate that resembles that which we saw in the decade of the 1970s. For those of your listeners who weren't there in the 1970s, we saw the prime rate at the beginning in 1970 at probably 4.75, and we saw the prime rate in 1980 at 18. It was an interesting circumstance.
And one of the reasons why we saw that, though, is because of inflation. It
Correct.
just ripped, and a big part of that had to do with the price of oil. I believe it was up 3 times because of the Yom Kippur War. But what about now? Do you see the threat of inflation accelerating here
I
in
do.
2025?
I do. I don't understand how you service $100 trillion in politically sensitive entitlements. The way I think you do it is you honor the nominal valuation. In other words, some old geezer named Rick Rule, who gets $4,000 a month in Social Security or whatever they pay me, continues to get it. But they devalue the purchasing power so that that $4,000 buys me $700 worth of goods and services. That's precisely what happened in the decade of the 1970s. The political forces would tell you that the whole problem in the decade of the 70s was the increase in the oil price. That was part of it. People forget that weren't there that we fought 2 wars simultaneously: Vietnam, which we lost, and the war on poverty, which we lost. We had a guns and butter policy, and there was a whole bunch of politically unsustainable programs. The way we dealt with that in the decade of the 1970s was allowing the deterioration of the purchasing power of the US dollar. And that's the way we're going to deal with the $100 trillion net present value of structural entitlement debt now. I don't see any other way out. I mean, you can do 2 things. You can have an honest default. You can call up the bondholders and say, too bad, so sad, times are tough, screw you, strong letter to follow. And you can say to Medicare holders, goodbye. You can say to Social Security guys, yeah, you paid in your whole life, so what? There's nothing left. Or you can inflate away the net present value of the obligation and not index taxes to inflation, which is precisely, I think, the way out. If that occurs, if I'm right, uh, with regards to inflation, as they say, you ain't seen nothing yet.
So if I take the other side of that argument in terms of debt, we've been talking about debt levels and excessive debt levels now for decades, and here we are, $36 trillion. It's growing by 100. It's growing by $1 trillion every 100 days, and now the interest payment on that debt is the single largest line budget in the budget. Um,
Your
you,
fallacy is that the debt isn't $36 trillion. The fallacy is that it's $136 trillion. We owe the bondholders $36 trillion. The demographics of the United States have changed. At the time that Social Security, as an example, was enacted, before Social Security was a disability program too, we sustained Americans at a poverty level from age 65. And the average life expectancy of an American male was 66. So demographically, we, we sustained people for the last year of their life at poverty levels. Now the average life expectancy of an American male is 82 years. And benefits begin for some people at age 62, unless they have disabilities where they can begin at age 5. And at the same time, the workforce is skewed. At inception, there were 4 workers for every beneficiary. In 3 years, we go to the point where there's more beneficiaries than there are contributors to Social Security. This is the debt that people don't consider when they think about the financial dilemma that faces the United States. And by the way, when I talk about the weakness in the US dollar, I'm talking about the US dollar relative to other fiat currencies, which I suspect will do worse. I'm talking about the dilemma in the world's reserve currency. Um, and by the way, we're going to get through this. I'm not one of these guys who says that the treasury market's going to blow up, that the dollar's going to go to the way of the dodo, anything like that. We got through the decade of the 70s, but it was tough. I mean, it was really, truly tough. There were some adjustments. And people your age who are planning to enjoy the same type of state-funded retirement that people my age have been able to do need to make other plans. They just need to make other plans. It's a really ugly thing to say. I say that publicly a lot. And people send me this hate mail saying, I've paid into Social Security my whole life. If they're going to stop it, then they need to send me a refund for everything I put in. To which I say, sir, using what for money?
so if we look at debt as a percentage of GDP, it's around 125 or 130%. There's
On
many
balance sheet, it's 400%.
there's many countries out there like Japan that are running over 200%. Why can't we just keep kicking this can down the road?
I think if we had the same rate of domestic savings that the Japanese had, that we probably could, but we don't. The internal household savings rate in Japan in the 50s, 60s, and 70s was almost 25%. The savings rate in the United States was closer to 5%. That's also a homogeneous population, and it's a population that I would suspect has greater life expectancy, higher educational levels, and probably better personal habits without going into exquisite detail. You don't notice Japan with a fentanyl problem.
The deficit as a percentage of GDP is around 6 or 7%. And Scott Bessent, the Treasury Secretary, has said he wants to get it down to 3%. Do you think that's possible in the next 4 years?
Not a prayer. I don't know if you saw the GOP budget last week. Um, I guess what the Republicans want to do is they want to reduce Democratic spending. They don't want to reduce Republican spending. The budget bill that was just passed was a real budget buster. If you look at Mr. Trump's first term in office, he was anything but fiscally conservative. So my suspicion, unfortunately, is that most of the discussion around reducing the size of government is theater. There's a wonderful book about this, by the way, your listeners should read. A book called The Triumph of Politics by David Stockman. David Stockman was the director of the Office of Management and Budget in the Reagan years. Reagan had a real mandate to reduce the size of government. Trump figuratively won by an eyelash, and Reagan won by a landslide. And in The Triumph of Politics, David Stockman describes the political derailment of the movement to reduce the size of government. I'm hoping past isn't prologue, but I suspect it is.
So the government's going to have to finance trillions of dollars worth of debt this year as it comes up for refinancing. And let's just say the 10 years around 450 right now, just for simplicity's sake. What do you think the bond market says in the coming months? Do you think they say, you know what, we're not going to give you money at 4.5, we want 5.5, or maybe it's 6.5? Do you see interest rates going that much higher?
I think there's still enough faith, however misplaced, in the U.S. economy that they will manage to keep a lid on interest rates for 12 to 18 months. You know, it's really a confidence game. And ironically, when you look at the strength of the U.S. economy relative to other economies, the U.S. economy in a relative sense doesn't look bad. It just looks bad in an absolute sense. So for global investors, they look at a negative real yield in the U.S. dollar as opposed to a negative real and nominal loss in other currencies, and they still favor the U.S. dollar. Despite Mr. Trump's recent tariff package, there's been a very strong influx of foreign capital into the United States. As unattractive as the United States looks to an American, for people in other countries, when they compare our circumstance with their own circumstance, it's still relatively attractive, which I think, and you know, confidence can go away. It can really, truly go away. But until confidence does go away, or if it doesn't go away, they will be able to maintain artificially low interest rates.
Yes, I can't get over the strength of the U.S. dollar, especially against the Canadian currency. It's killing me. Cappuccino's costing me $10 now.
Right.
I think the Canadian dollar was down 10% in 2024 against the USD.
Yep.
Do you continue to see the U.S. dollar gather strength here in the coming year,
Relative to the Canadian dollar? Yes.
or relative to all
Yeah.
major currencies?
Yeah. Yeah. I mean, how do I say this politely? If your budget had balanced itself, or if your prime minister had found a business case for Canadian oil and gas, the circumstance would be different, but that didn't happen.
Rick, I want to ask you about gold equities now. You're very bullish on gold. And I guess you could say the performance in gold equities has been mixed. Some have done very well, others have not done so well. And I'm going to first look at Newmont, the world's largest gold producer.
Right.
It's going to It's on track to produce, I believe, 6.9 million ounces. Okay. But the price of gold was up 40% in the past year. Newmont was up 40% in the past year. And the reason why we buy gold equities is because we want leverage to the gold price. We want to see 60, 80, or 100% returns. What are your thoughts on that? And why are so many names like Newmont, and I can also look at Barrick, it's also been underperforming significantly. But why are these names underperforming the way they are?
Two reasons, I suspect. The first is that in the period 2000 to 2010, where the gold price went up sevenfold or eightfold, free cash flow per share of the XAU fell. It takes real skill for an industry to have declining free cash flow per share when the product that they sell is up sevenfold. So investors' expectations around gold equities are, to be charitable, uh, poor. The second thing is that in the period 2022, 2023, although the gold price went up, the price of inputs to produce gold went up a lot too. And the margins didn't reflect the increase in the gold price. That's begun to turn around. The expectation is very low. I think the gold equities are, um, I think they're cheap. And there's only been two times in my life when I felt that they were cheap compared to the gold price, this being one of them. I've been a fairly public bear about Newmont for some time. Their costs have been high and stubbornly high. It isn't just that their costs have been high, it's that they've missed guidance for 7 quarters in a row. In other words, their costs have been higher than they thought that they would be, not that the industry thought that they would be. That was problematic. I'm personally beginning to change my tune on Newmont. I had a very long conversation with several people inside Newmont last week, lasted 2 hours. Uh, I had very high hopes after the Newcrest acquisition that Newmont would do what they suggested they were going to do and sell off most of their second-tier mines. That would theoretically do two things: strengthen their balance sheet, but probably more importantly, it would free their love, care, and attention for high-quality mines and attention that had been diverted by smaller mines. They had anticipated raising $2 billion from those sales. So far, they've raised 4.1. They have fixed the hole in the balance sheet at the same time that they have lost through sale most of their higher cost operations, while simultaneously reducing the number of mines that they have to fix and repair. So I don't own Newmont yet, but I have to admit I sold some Newmont puts. Um, if you look back at the last 2 years at the companies that have performed corporately, they've performed in the market. Those companies which have delivered good corporate performance have been rewarded in the share market. I would point to Alamos Gold and Lundin Gold as more moderate-sized producers that have also enjoyed a really virtuous reception in markets because they deserved it.
When we talk about Newmont, you made mention of the fact that they acquired Newcrest in 2023. In 2019, they acquired Goldcorp.
Correct.
And even after those two very large acquisitions, they're still producing less than 7 million ounces a year. And at one time, they used to produce over 8 million. Barrick, it's the same thing. At one time, they used to produce 8 million ounces a year. Now it's under 4 million ounces. And here's the other interesting element to this equation. When we talk about the demand coming from central bank buying, you look at the supply side, there's not a lot of new mines coming on. The only way companies like Newmont and Barrick can grow production is through acquisition. They're not finding any new major gold reserves or major gold mines.
And there aren't many acquisitions that move the scale at a Barrick or a Newmont. Barrick has decided to address that problem by becoming a copper company and drag, Lumwana and Reko Diq, which is probably a good decision. They may or may not lose the gold multiple, but assuming that they're successful putting Reko Diq in operation, they may stem the revenue decline. But the truth is, if you look at a company that's producing 5 million ounces a year, replacing 5 million ounces a year by any method, acquisition or exploration, is a very difficult job. And one wonders whether the correct response might not be to do what Newmont did, uh, which is to say, take all of the second tier operations, sell them to other people. Uh, it may be now that they have to, you know, try to find a 10 million ounce single asset producer that they can pay too much for. Who knows? Or maybe they just decide, you know what, we're going to become an extremely profitable 4.5 million ounce producer. There wouldn't be anything wrong with that. The idea is at the end of the year, you have either distributed cash or you've used that cash to increase your net present value per share. The gold industry really since 2000 has decided that they wanted to be growth golds. And the consequence of that is that they've been, I'll be charitable and say, mediocre financial performers.
I want to get your opinion on gold lease rates. There's been a lot of commentary recently about gold being transported from London to New York, and they're trying to take advantage of the spread difference. Just last month alone, JP Morgan transported over $4 billion worth of gold. HSBC has also been a big mover of gold from London to New York. But what are your views on this? What do you think is really happening here?
Well, I think partly it is a disparity in lease rates. If you are able to get 3.25 here versus 2 there, yes, it's 1.2%, but expressed differently, it's 30%, which is important on large sums of money. I think some of the disparity may have to do with the anticipation of tariffs. I don't know. But the truth is, these very large, very sudden financial flows explain themselves usually 12 months afterwards, at least for me. Not understanding as much about global financial markets as I would hope, albeit understanding more about global financial markets than most folks. What I've learned is that whatever the supposition is in the popular press 12 months hence, usually it was something else.
The US government holds 8,100 tons of gold, and it's valued at $42.22 an ounce. And that was the number that was determined in 1973. And there's been a lot of commentary recently that the US government should mark their gold holdings to the whatever the market price is, $2,500 or $3,000 an ounce. And this would add a significant increase to their balance sheet. $750 billion is what I've read. But what do you think that would do? Do you think that's a positive? Do you think that's a negative?
I think it probably ought to be valued at some number closer to market. I don't think it'll matter as a bondholder if they restate the value of the asset, but you don't have a claim on it. Who cares? Can you imagine me as a U.S. bondholder going up to Washington, D.C. and saying, I'd like my gold, please? I mean, they have an army, right? And if you think about revaluing the gold in the context of $130 trillion in liabilities, the importance of that gold is, it's a hiccup in a windstorm. It really doesn't matter. I personally believe the gold is there, but I don't want to have to believe. We're sitting in Sprott's office right now. The technology for a gold audit is something that Sprott perfected at the beginning of the Sprott Gold and Silver Trust. It's real tough. 1 bar, 2 bar, 3 bar, sample a few bars. I think that there should be an audit of that gold. And I think that there ought to be, in effect, a title opinion. Never mind, is it there? Is it hypothecated? Who does it belong to? Are there claims against it? I'm actually, on this one, probably willing to take the U.S. government's word for it. But I think they owe the American people an explanation. There hasn't been an audit of that gold for 40 years. And I don't mean a theatrical audit. I don't mean that Trump and Musk walking through there with a phone, taking a video of the gold and saying, yep, I petted it, it's all there. That's not what I mean. I mean Pricewaterhouse or KPMG auditing that gold the same way that Sprott's gold is audited. I think if that gold belongs to the American people, that the American people have the right to know, first of all, that the gold is there, and second of all, that it's theirs. That's not asking too much.
Rick, we started this conversation by talking about the uncertainty throughout the world right now. And Jamie Dimon recently said the geopolitical risks that we're experiencing throughout the world right now are the greatest that we've seen since World War II. When you look at the global economy, what concerns you the most? And if there was a black swan event that might occur in the coming year, what could it be?
Two black swans. One is the realization in the United States and around the world that the United States is much less solvent than people believe, that the world's reserve currency, well, put differently, on balance sheet and off balance sheet liabilities exceed 4 times GDP. $130 trillion in debt against $5 trillion a year gross revenue to the federal government. This is crummy math. And if the rest of the world develops the same concern about it that I have, we have a much less confident world. The expression of that scares me the most is in the high yield corporate credit markets, the junk bond markets. There are trillions of dollars of high yield ETFs owned by fairly unsophisticated mas and pas who are yield chasers. They don't understand anything about the credits that generate those yields. Now, at the top level, the ETF, you have extraordinary liquidity. These junk bond ETFs trade billions of dollars a day. But where the liquidity isn't is in the asset class. These are extremely illiquid. If we have a circumstance where people become concerned about a credit class, like they did in 2008, when the mas and pas go to sell the ETF, and the ETF has to sell the underlying assets, which are illiquid, to satisfy the liquidity demands at the topco, you have a run on banks that don't have FDIC insurance. When I was a young man, we had a very illiquid high-yield bond market in the 70s. And we used to talk about something called an owl bond. An owl bond is when you call your broker and say, please sell, and your broker says, to who? To who? And the black swan that scares the hell out of me is a credit concern that spreads to the high-yield bond market and causes disintermediation in high-yield bond ETFs. That to me is a recipe for 2008.
Rick, as we wrap up, can you just summarize for us why you think it's important that investors have an allocation toward gold during this economic environment?
For 1,000 years, at least, gold has been a medium of exchange and a store of value. When people ask me, when's gold going to move? I scratch my chin sagely and I say 2000. It's gone from $250 to what, 2,800 bucks? It's up sevenfold. 8% compounded, that's what it's supposed to do. Unfortunately, I believe that the performance becomes more profound because gold performs particularly well when people are concerned about the maintenance of their purchasing power in securities that are priced in fiat currencies, in particular securities that are priced in the world's reserve currency, which is the US dollar. And while I believe that the US dollar will do relatively well against other fiat currencies, I don't believe it's going to do absolutely well. And that fear means that for my savings, don't get me wrong, I maintain a lot of US dollar liquidity in 12-month, 18-month notes. But I maintain liquidity in dollars. I maintain capital. I maintain savings in gold. And it's very difficult for me when I hear people criticize that and I ask them about the arithmetic of America's unfunded entitlement liabilities. I just don't understand the disconnect at all. I've done my part. I'm going to be fine. And by the way, I'd love to be wrong. I would love to be wrong. Nothing in the world would make me happier than being wrong.
Rick, thank you for being with us today.
Pleasure. Thank you.